The US dollar's continuing hegemony as an international currency, the double matrix analysis of global monetary power. Introduction. The structure of monetary dominance. The presence of the US dollar as a dominant international currency represents one of the most consequential structural features of the global political economy. Despite repeated predictions of decline, systematic crisis, and the rise of competing currencies such as euro or the renminbi, the dollar continues to occupy a hegemonic position within the international monetary system. The persistence of this dominance cannot be explained solely through traditional macroeconomic indicators, such as trade balances, fiscal deficits, or relative growth rates. Rather, the architecture of a global financial market, institutional trust, and structural embedding of a dollar-dominated assets within international portfolio produces a reinforcing mechanism that stabilizes the dollar's position over time. The concept of dollar hegemony is frequently interpreted through the lens of international political economy as a reflection of American geopolitical power. However, this interpretation is incomplete because it neglects the structural role of financial markets and the transformation of financial securities into global commodities that store value across time and geography. The modern global financial system is characterized by increasing commodification of financial assets such as bonds and equities, which serve not only as instruments of funding but also as intentionally demanded stores of value. The central argument emerging from the double matrix analytical framework is that the dollar hegemony is not simply a product of American state power but rather a structural outcome of the scale, liquidity, and institutional credibility of the US financial markets. The size and depth of US capital markets generate network effects that make displacement of dollar extremely difficult. As investors require large liquid and standardized markets in order to preserve capital and manage risk efficiently, the concept of international currency functions and international currency performs multiple functions with the global economic system. These functions include acting as a medium of exchange in international trade, serving as a unit of account for pricing goods and services, and functioning as a store of value for both private investors and central banks. The interaction between these functions produces a structural hierarchy among currencies in which one currency achieves dominance by fulfilling these roles more effectively than its competitors. The dominance of the dollar reflects the ability to operate simultaneously across both private and official spheres of economic activity. Private actors such as multinational corporations, hedge funds, institutional investors use dollar for transactions, pricing, and portfolio management. Official actors such as central banks, sovereign wealth funds accumulate dollar-denominated reserves to stabilize the exchange rate and manage macroeconomic volatility. The persistence of dollar dominance is reinforced by the interdependence between these two spheres. When private investors demand dollar-denominated assets, central banks are incentivized to accumulate dollar reserves as when private investors demand dollar-denominated assets, central banks are incentivized to accumulate dollar reserves in order to maintain exchange rate stability and ensure access to international liquidity. Conversely, when central banks hold large stocks of dollar reserves, private investors interpret this as a signal of confidence in the dollar's long-term stability, further reinforcing demand. This mutually reinforcing cycle produces a self-sustaining equilibrium in which dollar remains the focal point of international monetary activity. The double matrix framework, linking agents and commodities. The double matrix analytical framework expands the conventional understanding of international currency exchange dominance by introducing a second dimension to a traditional matrix linking currency functions to economic agents. In the conventional framework, currencies serve functions for two types of agents, private actors and official actors. The double matrix approach adds another dimension by linking currency functions to two types of commodities, real goods and financial securities. This expanded framework highlights the structural importance of financial markets in sustaining dollar hegemony. Financial securities such as US Treasury bonds, corporate bonds, and equities are not merely instruments of borrowing or investment, they are globally traded commodities that provide liquidity, safety, and predictable returns. The commodification of financial investors require access to currencies associated with large and liquid financial markets. Because the United States possesses the largest and most liquid capital markets in the world, the dollar benefits from a structural advantage that cannot be easily replicated by competing currencies. Even if alternative economies exhibit strong macroeconomic fundamentals, their financial markets lack the scale and institutional debt. Even if alternative economies exhibit strong macroeconomic fundamentals, their financial markets lack the scale and institutional depth required to absorb global demand for safety assets. Safe haven dynamics and crisis behavior. One of the most powerful demonstrations of dollar hegemony occurs during periods of financial crisis. Contrary to the expectation that crisis originated in United States would weaken confidence in the dollar, historical evidence suggests that global investors increased their demand for dollar-denominated assets during periods of uncertainty. The global financial crisis of 2008 provides a critical example of this phenomenon as investors shifted capital towards US Treasury securities despite the ongoing crisis originated in the United States financial system. This behavior reflects the scarcity of safe assets in global financial markets. Safe assets are defined not only by low default risk but by high liquidity, transparent governance structures, reliable legal frameworks. The US Treasury market remains unparalleled in its ability to provide these characteristics simultaneously. The concentration of safe assets within the US financial markets creates a structural dependency in which global investors are compelled to hold dollar denominated securities, regardless of geopolitical tension or macroeconomic imbalance. The dependence reinforces the dollar's role as global reserve currency. Structural demand for dollar-denominated security. Foreign ownership of U.S. financial security demonstrates the structural demand for dollar-denominated assets within global investment portfolios. The scale of U.S. capital markets ensures that institutional investors can allocate large volumes of capital without encountering liquidity constraints or excessive volatility. The uniformity and standardization of U.S. financial instruments further enhance their attractiveness to global investors. Consistent disclosure standards, regulatory oversight, and governance framework reduces informal asymmetries and enable investors to evaluate risk more effectively. These institutional characteristics reduce transaction costs and facilitate portfolio diversification, making U.S. financial markets are the preferred destination for global capital flows. The result is a structural feedback loop in which the demand for dollar-denominated assets increases the liquidity of U.S. markets, which in turn attracts additional investors. Official reserves and exchange rate stability. Central banks accumulate foreign exchange reserves in order to manage exchange rate volatility and protect domestic economies from speculation capital flows. The majority of these reserves are held in dollar denominated assets, reflecting the dollar's central role in international monetary policy system. The accumulation of dollar reserves serves multiple strategic purposes. It allows governments to intervene in foreign exchange markets, stabilize domestic currencies, and maintain investor confidence. It also provides insurance against sudden reversals of capital flows that could destabilize domestic financial system. The high proportion of global reserves held in dollars demonstrates the extent to which the international monetary system remains anchored to dollar. Governments rely on dollar reserves to protect against speculative attacks and to maintain macroeconomic stability, reinforcing the dollar's hegemonic position. Network effects and the path dependence in currency dominance. Currency dominance exhibits strong network effects, meaning that the value of a currency increases as more agents adopt it. Once a currency becomes widely used for trade, investment, and reserve accumulation, switching it to an alternative currency becomes costly and risky. Path dependence further reinforces currency dominance by creating institutional inertia. Financial contracts, trade agreements, and pricing conventions are often denominated in dollars, making transition to alternative currencies complex and costly. The structural advantage of the dollar therefore extends beyond macroeconomic performance to include institutional embeddedness within global economic practices. Even if competing currencies achieve comparable levels of economic strength, overcoming the inertia of existing financial networks presents a significant barrier to displacement. The limits to potential challenges. Several currencies have been proposed as potential challenges to the dollar, including the euro and the Chinese renminbi. However, these currencies face structural limitations that constrain their ability to achieve global dominance. The euro is constrained by institutional fragmentation within the European Union as a fiscal authority remains decentralized across member states. This fragmentation limits the ability of the eurozone to produce large quantities of safe assets comparable to US Treasury securities. The renminbi faces restrictions related to capital controls, regulatory transparency, and legal predictability. Global investors require assurance that they can move capital freely and that property rights will be protected by independent legal institutions. Until alternative financial systems develop comparable levels of scale, liquidity, and institutional credibility, the dollar is likely to maintain its hegemonic position. Financial commodities as the foundation of monetary power. The transformation of financial securities into global traded commodities represents one of the most significant developments in the evolution of international monetary system. Bonds, equities function as stores of value that allow investors to preserve wealth across time and geography. Because these financial commodities are predominantly dominated in dollars, the demand for dollar-denominated assets generates structural demand for the dollar itself. This dynamic reinforces the centrality of U.S. financial markets within the global economic system. The commodification of financial securities therefore constitutes the foundation of modern monetary power. The ability to produce large quantities of scale and liquid financial assets confers structural advantages that extends beyond traditional measures of economic strength. Conclusion: structural persistence of dollar hegemony. The persistence of dollar hegemony reflects the structural characteristics of the global financial system rather than temporary macroeconomic advantages. The double mix analytical framework demonstrates that the dominance of the dollar is reinforced by the interaction between currency functions, economic agents, and financial commodities. The scale, liquidity, and institutional credibility of U.S. capital market create structural dependence that bind global investors to the dollar. These dependencies generate network effects and path dependence that make displacement to the dollar unlikely in the foreseeable future. Unless competing economies develop financial markets capable of producing comparable quantities of safe and liquid assets, the dollar will continue to function as the central pillar of the international monetary system. The endurance of dollar hegemony therefore reflects not merely political influence or economic strength, but the structural logic of global capital itself.